Coming up in today's show, stocks finish a good week mixed, the Fed walks back dovish comments, Barron's predictions for next year, what the consensus trade is, shipping stocks jump, and do we have too much of a good thing? Welcome back to the Click Capital Daily Market Show, everybody. My name's Jared. I'm going to run you through all the most important used data and charts across financial markets today and get you up to speed on where everything is at, including some developing themes and trends across markets. And so we just finished a pretty good week on Wall Street, all major indices finishing on the green. However, today it was a bit more mixed and there was quite a bit of bearish breadth out there. We've got a bit of a turn down, except for mega cap tech, once again trading different from the pack, with a bit of strength in the semis and a bit of weakness in utilities and REITs, along with some healthcare stocks pulling back as well. And so just looking at the SPY ETF, like I was saying yesterday, we could potentially be putting in an island reversal formation here. That's where we gapped up yesterday, did a bit of a spinning doji, and we've gapped down today and done another little spinning doji. And just taking you down to a 5-minute chart, look at those two funny candles to finish out the week there. We popped up over a point going into the close, then the last 5 minutes of the day, we turned right back down to finish at 469. And there's a similar pattern on the Nasdaq, Dow Jones, and Russell 2000 as well, with the losing index today being mid-caps. And like I've been saying, we're looking a bit stretched up here, getting a bit technically overbought, got a big bullish consensus out there, a lot of sediment indicators reaching extremes, and we're starting to see a bit of a climb in volatility risk premium. That's the level of implied volatilities option dealers are asking above realized. And another reading we've got, which gives a good probability that we're near a short-term top, is the put-call ratio in equities, super low at 0.63. And another big day in the options market, not as big as yesterday, which was a monster, but still reasonable volume of 47.7 million contracts, so it wasn't a huge quad witching day. However, it's super lopsided, 60% of them are calls, and 56% of option volume is in contracts expiring by next Friday. So a lot of people banking that this market's going to go higher next week. And looking at my S&P 500 oscillator, it's still really elevated here at 64.29, and we've got these big bearish divergences in the market, like we can see in my hidden divergence indicator that's showing up in S&P 500, the Nasdaq, and the Russell 2000 as well. And just looking at the Russell 2000, we're coming up just right in this big resistance zone where the market's turned 3 times before over the last year and a half. And just going out to a weekly chart in SPY, we're coming up to what I'm calling the all-time high resistance zone where the market last peaked out at the start of last year. And this could be a place where the market at least consolidates and potentially reverses here. And this parabolic run could be coming to an end. We haven't had a 1% down day in the S&P since back here in mid-late October. And we've had quite a lot of people pile on board this trade here, as there's a strong consensus out there that we are going higher and higher going into next year. And just before I move on with the daily show, just want to say a huge thank you to everyone who's taken advantage of my Christmas special and gotten lifetime access to all my custom indicators for TradingView that you've just seen some on the charts then, including access to my latest investment presentation. And I'm excited to bring you guys more cutting edge, unique indicators that nobody else has going into next year as well. And anyone who takes advantage of this special will get all my future indicators free of charge. So if you're interested in learning more about that, click the link below this video or head on over to my website, clickcapital.io. Click on the red banner up the top, then you'll come to my Christmas special page and you can learn more about this special offer, which is only available until Christmas Eve, and you can save over $200 by taking advantage of that. So check it out if you're interested. So markets have been getting really excited, especially this week after Jay Powell's surprise about face coming out pretty dovish after being a hawk all year. We've still got core inflation at 4%. The economy is holding up pretty good, so it was curious to see Jay come out and indicate some rate cuts, and it is quite convenient going into an election and with the US government having to refinance so much of their debt next year. And this is at a time when other major central banks around the world who are experiencing much lower economic growth than the States aren't even talking about cuts either. So we had New York Fed president come out today and said the central bank isn't really talking about rate cuts. He went on to say, we're very focused on the question in front of us, which, as Chair Powell said, is have you gotten monetary policy to a sufficiently restrictive stance? And on the prospect of a rate cut in March, Williams said it's just premature to be even thinking about that. However, it looks like Jay Powell is already thinking about that. And what did he see to spook him? Why is he already talking about rate cuts when we've still got core inflation at 4%? Because we've got Fed Fund futures given a 70% chance that they will cut rates in March. And so this is only a couple of months away, and all the latest economic data shows the economy holding up pretty good. So what would make the Fed want to cut rates just in a couple of months' time from now? And what's going to make the Fed cut rates 150 basis points next year, take them down to below 4%? Because something's got Fed Fund futures and the bond market a little spooked as well, because we've got the 10-year sitting down here under 4% now at 391, deepening the inversion between the 2-year, which is still above 4% at 444. And so are we really going to see some much lower CPI prints between now and March? Or are we going to get a surprise in the form of something else? Or is unemployment going to take a big tick up? Because at least one of those things have to happen for the Fed to cut rates just in a couple of months' time. And can you just imagine if we got an uptick in CPI? Wouldn't that be a surprise to markets? And the way risk assets are trading, and now with substantially lower rates, that could actually set the grounds for another uptick in inflation in a couple of months' time. Because just as the higher rates had been doing the Fed's job for it, maybe the opposite is true as well. Lower rates could actually ramp up inflation again. Because the consensus now is well and truly inflation's coming down, we're going to have a soft landing, stock market's going to keep ripping next year, mega cap tech's going to keep doing well, AI is the dominant theme, bond market has bottomed, we're in the Goldilocks period, etc., etc. However, what happens if these two lines here were to keep correlating? And what you're looking at is the annual change in the Consumer Price Index, CPI, the biggest measure of inflation. And in the blue line is the annual change in CPI since 2020. And we can see that ripped up into 2022 and has pulled back, as has oil. And what you're seeing here in the dashed orange line is the annual change in CPI from 1972 to 1983. So in the early 70s, we had that peak in inflation, then it came back down. And a lot of people back then thought too, the spike in inflation is over, we're back to normal. However, that didn't last long. It literally bounced off 2% and made a second wave higher above 11% before finally coming down into the early 80s, where the stock market bottomed in 1982. And so during the 70s, that was a lost decade for the stock market. Best performing asset class was commodities, gold and oil and other things like that. And so if we were to get a resurgence, second wave higher in inflation, that would catch a lot of people and markets off guard. And if the Fed were to cut rates in the next couple of months, well, we've still got risk assets hitting highs. That's going to leave them with egg on their face and could actually contribute to that. And a big factor in that is going to be the price of oil, just like it was back in the 70s. And so the stock market's been really resilient this year. It's been quite remarkable that the S&P 500 is trading 8% higher than before the Fed started hiking rates. And so investors are betting inflation is over, a recession has been avoided and rates are coming down, and the record inverted bond yield curve is going to be wrong for the first time ever, and that we're at the start of a new bull market, and those higher rates won't hurt the economy enough to push it into a recession. And we've even got big publications like Barron's saying stocks beat the odds this year, why they can do it again, with the biggest reason saying stocks should finish stronger as interest rates fall. Stay invested. However, there's what's known as the magazine cover indicator, and that is if you were just to follow the big headlines from big stories from popular media publications, looking back over 100 years, they haven't done so well. And that's because journalists like to write stories and headlines based on what everyone's talking about, because that's what's going to sell the most amount of magazines, that's what's going to get the most amount of clicks onto an article. Here's a famous one from Businessweek in 1979, the death of equities after that lost decade, how inflation was destroying the stock market, and that was pretty close to the bottom in the stock market, which happened about 6 months later before going on to a huge 40-year secular bull run that we're still in the late stage of. And so the consensus isn't always wrong. Magazine indicators is not a short-term one. Here's another good one from late 1999, GetRich.com. Not too far from the top, and just before the Nasdaq fell 80% over the next couple of years. And so generally in the long run, it's hard to make good money by copying what everyone else is doing and being late to the party. By the time you see it on a magazine cover, it's probably already been had, whatever they're talking about. However, we're all vulnerable to getting caught up in the story of the day. As we evolved as humans, to have that sheep following mentality, which was based on our survival, it was safest to copy what most people were doing and follow the crowd. However, that natural instinct can be really detrimental to good long-term returns in the stock market and can fool even the best of us to think that this time is different. There's some new paradigm that's going to propel us into a new world. However, like all the research I've read in my trading and investing career, is that valuations do matter and that they do revert to the mean in the long term. And just looking at probably the best valuation metric on the US stock market, that's the Shiller PE ratio. You could think of it as a 10-year PE ratio. They look at the last 10-year earnings adjusted for inflation divided by price. The only time we've been higher than where we are now was back in late 2021 and at the peak of the tech bubble in December 1999. And we're actually higher now than where we were back in August 1929 before the big crash in Wall Street back then, when stocks also fell 80% in just a couple of years, going into another lost decade in the 1930s. However, this time's different because of AI, right? That's what a lot of people are saying. So just like the consensus was at the start of this year that we were getting a recession, maybe the consensus for next year is also wrong. Maybe we don't get the soft landing. Maybe the Fed Fund futures are right. We're going to get a hard landing. Something's going to break. We may get a surprise. And just looking at a long-term 2-month chart of the NASDAQ, which since the start of 2009, currently up 1,500%. That's the NASDAQ tech stocks. They're 15x in 14 years. Looking back in history, you'll be hard-pressed to find another time that any other major market has increased more than that in just 14 years. And so maybe, just maybe, the consensus is wrong, and then maybe we're setting up for a double top here. I guess we'll just have to wait and see who's going to be right next year, the stock market or the bond market, because we've still got bond market volatility as elevated as it's ever been relative to stock market volatility. So right now the bond market strongly disagrees with the stock market on where things are going next year. Moving on to commodities, we've got oil putting in the first weekly gain in 8 weeks as we've got more flare-ups coming out of the Middle East, this time from another Iran-backed rebel group coming out of Yemen, attacking commercial ships in the Red Sea, an important shipping route in the world where about 10% of global volume goes through. It's making ships have to take longer routes, more costly, and delays, just furthering commodity supply side constraints. And they're coming out in support of Hamas and want to attack ships going to Israel. The war over there is certainly not finished. However, that shouldn't be too much of a problem because the US military is likely to neutralize those attackers in the coming days, especially if they keep ramping it up. But we not only have little flare up in the Middle East. We've got some record oil production coming out of not only the States, but also Brazil and Guyana, pumping out the dirty stuff at records as well. Now OPEC Plus only has about half of the global oil market share, which is still a significant swing factor, especially since they want the price of oil higher. The States and the West want it much lower. It looks like the West has been getting their way. And that's really what's helped inflation expectations and CPI prints come down these last couple of months. Instead of heading to $100 a barrel, here we are just down in the low 70s. And we may have found support in this zone I've been talking about, 67.50. Will be bounced off on Wednesday, but was a bit of a weak volume here today. Still too early to call this a definitive bottom. And any blockages to shipping routes shouldn't last too long in reality, because like I said, the US military and their allies will likely neutralize any of those attackers, and we can get global commerce back up to speed probably in no time. The question for oil is more whether we see that demand destruction from the world's biggest consumer of oil, and that is Americans. And so like I was saying, with the pullback in rates, risk assets hitting highs, if we don't get the recession, then we could see demand pick back up along with oil, and then that'll bring inflation back up as well, and then the Fed may have to pivot back to hawkish again. One of the big dominant themes in financial markets over the last 10 years has been the rise of American technology companies. And just to put that into context, Apple's valuation is now larger than all but 6 of the world's top economies. That's over $3 trillion in market cap, which is bigger than France's GDP at $2.7 trillion and Russia's at $2.2 trillion. So just think about that. One company that sells mobile phones and computers and a few other things has a larger value than the GDP of one of the world's oldest developed economies of France. It just makes you wonder, how much further can that go? Got a little bit of positive signs coming out of China, reporting their fastest industrial expansion in nearly 2 years. Retail sales climbed 10%, a little bit less than what analysts had expected at 12.5%. And maybe, just maybe, we're starting to see the bottoming of the Chinese economy. We've seen Beijing come out just this week with more stimulus measures. They really want to put a bottom in there. They know they've been significantly underperforming the West, and their strategy of aligning themselves with Russia isn't panning out as much as they've hoped. And so they may be looking to make a bit of a political pivot, and that is evidenced by Xi Jinping visiting the States about a month ago and trying to come back to the table and talk business. That helped to give a bit of a pop in Chinese tech stocks today on an otherwise bearish breadth day out there. And my favorite of the bunch, Alibaba, may have put in a bottom in the low 70s. Like I've been saying, I think that's a good level for a long-term investment. Super cheap valuation and a big contrarian play going into next year, being long Chinese equities at a time when everyone's given up on them. Record outflows. In my opinion, that's been de-risked, and this has a potential to deliver big gains not only next year but for the next couple of years, even if we just get a basic reversion to the mean on valuation. Moving on to economic data today, we've got manufacturing and services PMIs out of Europe still in contraction territory, coming in lower than expected. They're still in a state of stagflation. Got industrial production out of the States coming in a little worse than expected, contracting 0.4% year over year, along with manufacturing PMI, but has been the trend all year. Services holding up a bit better than manufacturing, still in expansion territory above 50. Looking at the next week, the last week before Christmas, we've got Bank of Japan interest rate decision. some CPI data out of the Eurozone and Canada, housing data from the States, inflation data from United Kingdom, along with some GDP data from the States, weekly jobless claims, and a bit more inflation data and GDP data from Japan and across the Eurozone. Finishing out the week with some PCE and durable goods data. It's no surprise we've got the fear and greed index still elevated there at 67, and corporate insiders still locking in some profits before Christmas and not doing a whole lot of buying either. Over to the charts and just looking at breadth, a little softer today. Only 504 stocks and ETFs breaking out to the new 52-week highs. Notable ones being Uber, Amazon, Costco, Home Depot, Boeing, and Intel. And lower again, only 44 stocks and ETFs breaking down to 52-week lows. Mostly just short ETFs and a few individual stock names, nothing too big in there. The short-term breadth still elevated, 82% of stocks above the 20-day average. And just flicking on my sector trends table indicator, you can still see a lot of green out there. Most sectors above their 5, 20, 50, and 200-day moving averages. A little bit of weakness at the front in the defensives, utilities, staples, and healthcare underneath their 5 days, and still a bit of medium-term weakness in the oil and gas and energy. Other than that, that is bullish across the board. But when we're that bullish, that can be a little bit of a contrarian signal as well. Another VIX Friday finishing lower, really depressed down here. This can go on for some time, but it's just setting up the grounds for that VIX spike that'll inevitably come. And look at realized volatility at 7.5. It's actual movement in the market, super low down here. But we did get a bit of a spike today in the VVIX. That's the volatility of the VIX index, and that can sometimes be a precursor of things to come. There's TLT hugging onto those highs, really elevated here, but we got a little bit of a pullback in the risk-sensitive high-yield bond and a little bit of support found in the dollar index, with Bitcoin still trading just below year-to-date highs, and we've had a bit of a bounce the last couple of days in the commodity index. Was a weak finish for the week in Canada's TSX, down 1.2%. Same with the UK FTSE. German DAX has been super resilient. China 50 index finished Friday at lows. Nikkei still going sideways, and the Aussie 200 looking a little short-term overbought there. Got a year-to-date breakout in the growth versus defensive sector spread, and same with discretionary stocks versus staple stocks. Been a big growth rotation in the market. Over to stock sectors, the winner today was the cannabis ETF, looking to bounce back after that big fall on Tuesday. Distant second was robotics and artificial intelligence, and cybersecurity stocks coming in third. Losing sector today was ARC Innovation. Closely following that was utilities, pretty big fall for utilities, and regional banks after they had a huge week, big rip up, and a bit of a pullback in those other big sectors this week. Home builders, clean energy, and REITs. There's BlackRock breaking out again, remarkably strong. That is usually a good sign for the stock market overall. JP Morgan hitting 52-week highs. Apple just pulling back from its all-time highs. There's a look at Microsoft. NVDA coming up to all-time highs, and Tesla trading above $250 a share. A little mixed for meme stocks, mostly down. Active today was DocuSign. Said they're exploring a sale. Let me just take you out to a monthly chart on this. One of the favorite stocks from COVID. Remember, we're all stuck at home and we had to sign all our documents electronically. And everyone thought, well, that's the way it's going to be for the future now. It's never going back. Traded up above $300 a share. However, valuations matter, not just the story and how good it sounds. Like my stock fair value indicator only ever got up to $140 a share when we were trading above $300 a share. Negative business quality score, which it still has, and down we fell almost 90% over the next 2 years. So great business, great story, just got way too ahead of itself, priced in the future too quickly, and like always happens, the chickens came home to roost, and here we are today. They're looking to get out. There's Pfizer holding on after being sold off a couple of days ago. Doing a lot of volume here. Looks to me like this could be in the process of putting in a bottom, and that too is a very undervalued large cap stock, offering a dividend yield above 6%, which makes for a good compounder when you reinvest those dividends. There's Intel trading up again today, higher highs, higher lows, and Walgreens holding on to that nice pop it had this week, with a little bit of a pullback in the telecoms and regional banks as well after they had an amazing week, along with the big banks taking a bit of a breather here today. Alright guys, there it is. S&P 500 just sitting above 4,700. Right smack on about 100 points from all-time highs. However, that doesn't show what happened in the last 5 minutes of the day like I just showed you before. Had that big red candle to finish the day, and maybe we're just doing an island reversal formation here. Could be putting in a short-term top, may come back down and touch the 50-day VWAP. Then we'll see what's happening there. Still a lot of good technical signs for the stock market medium term. We very well could rally into the first Fed rate cut, and like the Fed Fund futures are saying, that could come as early as March. Other than that, the story of the last couple of weeks has been some big breadth thrusts on huge volume, especially in those beaten down sectors and stocks, value stocks, small caps outperforming, micro caps doing well. There's very bullish technical pattern in the Russell 2000 there, those big volume thrusts coil up in volatility, expand, coil up, expand. So that technical pattern doesn't typically just reverse and come smashing back down unless we get a real surprise. So any pullbacks we do get might be quick and shallow, a lot of buying the dips, a lot of people waiting to get back in. All that cash and money market funds, short-term savings and bonds isn't earning as much as it was a couple of months ago. So that could be looking to come back into dividend yielding stocks. And we've seen that in the dividend ETF, up over 20% just in the last month and a half. So I think that's already been playing out. But we are looking a bit stretched here, and the consensus is quite bullish. And that's typically a time we get a bit of a pullback or short-term reversal. And that's all I got for you this week, guys. Thanks very much for tuning in to the Click Capital Daily Market Show. And if you're interested in taking advantage of my Christmas special offer, head on over to my website, clickcapital.io/Christmas. Grab lifetime access to all my custom indicators, no ongoing costs. 7-day money-back guarantee. Gets you access to all future indicators I develop, plus my latest investment presentation report. Microcap stock, I think, has good potential of doubling or tripling over the next year or two. It's got everything going for it. And yesterday, they just increased their quarterly dividend. This is a $13 stock that pays 40 cents in dividends every quarter. There's not too many out there you'd find like that. And this is a company with basically no debt, management heavily invested, and a couple of key catalysts that could propel it much higher over the next year. So if you want to learn more about that, click the link below this video and take advantage of this special offer. Other than that, I wish you a relaxing weekend, and I'll see you again Tuesday night. Cheers.